Before any institution can build an effective AML program, someone has to understand the landscape they are operating in. That is what risk assessments do. They map the threats, the criminals trying to misuse the financial system. They map the vulnerabilities, the weaknesses that make it possible. And they generate a picture of residual risk, what is left after all the controls are in place. In the European Union, this work happens at 3 levels. The European Commission assesses risk across the entire bloc, member states conduct their own national risk assessments, and individual obliged entities must assess their own exposure. None of these levels can replace the others. They are designed to work together. The rules around risk assessments evolved significantly between the 4th and 6th AML directives. Under the 4th directive, the European Commission was required to assess AML and CFT risks every 2 years. Member states had to conduct national risk assessments and update them regularly. Obliged entities had to run their own assessments and make them available to their national supervisors. The 6th directive changed the cadence and added new layers of oversight. The Commission now publishes its assessment every 4 years, with the next one due by mid-July 2028. Starting in July 2030, the new Anti-Money Laundering Authority, AMLA, will issue public opinions on the Commission's report every 2 years. Member states must now complement their national risk assessments with sectoral risk assessments where relevant. The direction is clear, more structured, more accountable, and more granular at the sectoral level. 3 member states illustrate how national risk assessments work in practice: the Netherlands, France, and Germany. In the Netherlands, the responsible authority is the WODC, the Research and Data Center, a government research body that produces the national assessment. In France, responsibility sits with the COLB, the Conseil d'orientation de la lutte contre le blanchiment de capitaux et le financement du terrorisme. This body coordinates the national risk assessment and produces sectoral risk assessments by industry. In Germany, the national risk assessment is led by the Federal Ministry of Finance. Each country uses its own institutional architecture, but the objective is the same: to produce a credible, evidence-based picture of where money laundering and terrorist financing risks are concentrated. France's 2023 National Risk Assessment contained a particularly important spotlight on electronic money institutions, or EMIs. The assessment placed EMIs in the high vulnerability, high threat quadrant of the risk matrix. Residual risk remained elevated, even after accounting for the mitigation measures already in place. The reason cited was significant: insufficient maturity of EMI/AML programs, partly because many of these institutions had only recently been registered. They were new to compliance. Their controls had not yet been tested at scale. This is a pattern that recurs across fintech and payments: strong product growth, compliance infrastructure that has not kept pace. The 2023 NRA is a public document. Understanding it is relevant to any compliance professional operating in or near the French market. In April 2024, the French Prudential Supervisor, the ACPR, fined a French electronic money institution called Treezor €1 million for serious AML and customer due diligence failures. This case is worth understanding in detail. The fine came from a pattern of inadequate practices. Inadequate risk assessment methodology. Failure to differentiate meaningfully between high-risk and low-risk customers. Deficiencies in automated transaction monitoring tools. And crucially, those tools had been calibrated for fraud prevention, not for AML or CFT. That distinction matters enormously. Calibrating a transaction monitoring system for fraud detection is not the same as calibrating it for money laundering. The scenarios are different. The indicators are different. The thresholds are different. That distinction is a critical lesson from the Treezor case. Beyond the transaction monitoring failures, the ACPR identified 3 more serious deficiencies at Treezor. First, there was a lack of enhanced scrutiny for unusual or suspicious transactions and scenarios. When something looked odd, the right questions were not being asked. Second, there were unjustified delays in filing suspicious activity reports. Once suspicion arises, the obligation to report is time-sensitive. Delays are not acceptable unless there is a documented reason. Third, the corrective measures that had been put in place were found to be inadequate. This is significant because it suggests the institution was aware of problems and attempted to address them, but the remediation did not go far enough. Regulators look very closely at corrective measures. A firm that identifies a gap and fixes it properly is treated very differently from one that identifies a gap and implements a half measure. Proper compliance requires thorough action, not just awareness. Ensuring excellence is the only path forward. The Treezor case and the France 2023 National Risk Assessment belong in the same conversation, because they illustrate how the regulatory architecture is supposed to function end-to-end. The National Risk Assessment identifies that EMIs represent an elevated risk sector. The supervisor, in this case the ACPR, uses that intelligence to focus examination resources. The examination reveals specific institutional failures. A sanction follows, and that sanction becomes public. That public enforcement action then feeds back into the next round of risk assessment, and informs the entire industry about what is expected. This is the cycle the EU AML framework is designed to create: assess, supervise, enforce, and signal. For compliance professionals, understanding this cycle is not just academic. Every enforcement action in your sector is a message about what the regulator prioritizes. Reading those messages is part of the job. The EU AML framework is not just a set of rules to comply with. It is a living intelligence system, and risk assessments are its first instrument.